All right, so let's get started. First off, thank you everybody for coming. I'm Paul Sydlansky, the founder of Lake Road Advisors. Really excited to have everyone here for our first quarterly webinar, Behaviors That Lead and Don't Lead to Financial Success. So our goal for these webinars is to provide you insights in order to make better financial decisions. And when we thought about our topics and what we wanted to talk about for 2023, one thing became pretty clear, and it had to do with the financial success. So when we looked at clients and the history of working with folks, the clients who had the most financial success and wellness were those who exhibited good financial behaviors, consistent, healthy behaviors. It was less to do with windfalls, picking the right stock, or one-time events than consistent behavior that led to good outcomes. So saying that, I'm really excited to have Dan Egan here. He's the behavioral finance guru at Betterment. And Dan is going to actually help us today figure out how to make better financial and investment decisions. And so, Dan, I'd love to hand it off to you here for a second, just to introduce yourself and just talk a little bit about what is behavioral finance.
Absolutely. Thank you, Paul, for having me. Thank you, everybody, for showing up on a Friday. It's a beautiful day outside. I'm a little bit like, can we have this outside? Can we have class outside today? Let's let out. So I'll try to make this as fun and conversational as possible. And I assume, Paul, you're saying, like, if you have questions, type them in. I don't think I have the best voice, so I'm very happy to have other people pipe up. Would love to hear from everybody. So yeah, my name is Dan Egan. I have been doing behavioral finance in one way or the other for about 20 years now. I did it in grad school at the London School of Economics. After that, I actually worked for Barclays, which is a big universal bank in the UK. And I was specifically in their wealth management division, working with high net worth individuals, looking at everything from sort of like how are the portfolios crafted to meet specific aims that they have and reflect their views that they're going to feel comfortable holding those portfolios, to how do you help groups of people, like a large family who's a very wealthy family, make decisions about communal property and communal investment decisions and trust. And well, I mean, like, I'm a human being, I have feelings. Most of my background in sort of behavioral science is more about like the cognition element of it. So how do we think? How do we make decisions? How do we understand data when it's coming in? And the big thing there is, like, we humans evolved, and we don't need to get into some discussion of that. Humans seem like they evolved to do certain things very well. We look for patterns in things. We're a very social animal, and we care about what's going on with others around us. And that's very useful in some settings, and it can backfire in other settings. So we want to kind of think about this as like, we're pretty impressive. We're a really, really great animal here, but there are some things that go wrong. Can we optimize the edges of that in this modern society with smartphone apps and technology and everything to make us better? And so we're going to talk about sort of behavioral biases, mistakes we make. And I want to make this very clear, like, dentists get cavities, optometrists need to get glasses. I talk about this stuff partially because I do these things. This is not some sort of shame, and like, you will come out of this knowing and maybe understanding things. It's not like you've been vaccinated and you're good to go. It's like, this is just a self-knowledge thing to allow us to have a little bit more perspective and say, like, oh, I'm seeing a pattern of myself here, or here's something that I want to change. It's the system in my life to make myself happy. And these are mistakes that I've made that I'm just hoping to share some of that wisdom with you and get some of yours.
Awesome. Yeah, thank you, Dan. And I think that's a great point, and we'll talk about that. I have an example of a professional who came out and shared some of her mistakes when it came to behavioral biases. So we're going to try to make this a little interactive and fun. And so the way we're going to do it today is I'm going to share with Dan some examples of client situations that I've come across throughout my career. And Dan's going to explain maybe the type of behavior that's being exhibited, but more importantly, what we can do as investors to try to recognize or maybe deal with that behavior. Because like Dan said, everybody's going to make these mistakes or are going to have issues with this. So Dan, I'm going to go through these examples. As we go through it, we have a chat box, we have a Q&A. You have questions, please ask questions. We'll try to answer them as we go. If not, we'll have time at the end. But if not, let's jump right into it. All right, so first question or first example. I have a client who owns shares in a tech company that they've been working at for a half a decade. Now, when the
Oh man, I'm scared already.
Yeah, you probably know where this is going. So the client owns these shares, and at the time when they originally bought them, the company was high flying. The prospects for growth were amazing, and the future seemed unlimited. Fast forward to today, this position that they held that had a huge gain initially is now in a loss because this company's prospects for growth have pretty much disappeared. The stock has been crushed, and things aren't looking good. Despite the change in outlook for this company and the sector it's in, my client is really adverse to selling this position and just does not want to get rid of it. And so, Dan, what type of behavior is this person exhibiting here?
So one of the most consistent things we see in people is that we fear and feel losses dramatically stronger than we feel equivalent gains. Like we're worried about losing. And it's actually one of the earliest and most well-documented sort of trading biases called the disposition effect. And the first paper they found, it was in the early 1990s, found that people held on to positions that were in a loss 2 to 3 times as long as positions that were in a gain. And what they also noticed is that people would wait for it to get back to break even, and then they would sell. Like, okay, cool. I just want to get back to break even. I don't want to have to realize a loss. You might have a paper loss, but it's not a real loss till you have to sell it, or it just goes bankrupt. And I think this tendency to say, like, I don't want to admit that I might have made a bad decision. It could still come back. It hurts to make a loss real, where it feels good to make a gain real, to crystallize it. It's strong, it feels good to do good things. So good, they're in good company. This is not an unusual thing at all. We've seen it in a lot of places. There are a couple of things that I always, when I'm talking to somebody in this position, or when I've been into myself, I thought about, and a couple of ways to reframe something from here's where I started and where I am today. And a lot of behavioral stuff is about, like, our emotions come from things that have happened and not necessarily about things that will happen, and thinking about the future. Right. So recrafting this to say, like, okay, we're gonna stop caring about the past. We're gonna stop caring about where we started and the fact that we're lower than where we started, because that's not really relevant to the decision we're gonna make today that's gonna make us better off 3 to 5 years from now. Number one, I like looking at losses as assets. That is a tax asset right there. If I can sell out of it, and hey, if it's a long-term capital loss, I might still be able to use that to offset ordinary income, which is going to be taxed at a much higher rate. The one thing is saying, like, actually there's a value, there's a return on selling that thing, and to keep that in mind, that it's actually an asset that I can use in a different part of my life. Another one is, and I'm sure you've done this with clients, I do it with myself a lot, is kind of like resetting it to be like, is this actually what you want to be invested in? Should we buy more of it, right? If we were to wipe your portfolio out, clean slate it today, would you be like, what I really want is 70% of my wealth in one stock? That might be also, like, very related to my industry and highly correlated with investment, where you go, oh, no, that's not a good idea. Maybe I would have a little slice. Maybe I'd have a 5% slice, but I wouldn't overdo that. Doing that sort of annual reset, where instead of looking at what you own, you say, like, we're starting fresh. What should we own? What do we want to be owning? And how do we get, to that place? Because the decisions we make today are going to be the ones that we appreciate or don't appreciate 3 to 5 years from now. The decisions we make today influence future us, not past us.
Right. I think that's a good way. What about setting price limits, right? So going into an investment saying, look, if I have a return of 20 or 30%, I'm going to be out. And on the flip side, if I lose 10 or 20%, I'm going to be out.
It's fantastic. One of the other things is, like, when you're in the moment with something going on, we tend to make worse decisions. There's this weird hack, which is, like, if you make decisions for future you make better decisions. Very small example. If I go grocery shopping and I'm hungry, I'm going to buy a lot of salty and sweet stuff. If I do, like, a grocery shop that's going to be delivered a week from now, I'm going to buy a lot of vegetables and fruit and healthier stuff. There's something about being like, I'm going to set up a plan for the future that I'm going to be systematic about, that takes away the immediacy that drives us to have a lot of short-term behaviors. So price limits, I would say, even, going back in time, saying, like, you have a lot of concentrated stock. How do you want to get out of it? Let's set a plan, a diversification plan that we're going to commit to and do almost regardless of what the price has done. This is something that we want to diversify out of over time. Let's think about tax budgets that we can use up. So any kind of thing where you both allow yourself to make a decision that you're going to be systematic about in the future, and also where you're making lots of little decisions, like auto deposits are a great example. Auto selling out of a position like this is a great example. Make a decision once and allow that decision to compound out positively through time is a great approach.
Awesome. Awesome. All right, let's jump to example number 2. So we work with a pair of couples who are friends, and they have similar jobs, work in similar industries, live in a similar part of the country. And one of the couples has just recently bought 2 homes in the last 3 years. And the other couple is struggling to buy their first home. And the couple who's struggling to buy the first home feels frustrated, feels like they're feeling behind, like they're not measuring up, and they just don't understand how this other couple can do it when they think they have relatively similar resources. So, Dan, what type of behavior is this, and then how do we combat it?
Yep. Obviously, we know this. We're social animals. Like we are amazing as a species at working together and getting things, but there are some downsides to it, like comparing yourselves to other people. There's a lot going on here. I think one, there's so many different things to say. First is that we have to be aware that like wealth is what generally you don't see, right? A lot of the stuff that you're going to see, somebody's house, their car, their clothes, whatever the nice stuff is, that's stuff that they've bought. They're generally consuming it. Generally speaking, those are depreciating assets that are losing in value. That's but you see it, it's visible, and you're like, oh, that's really nice. I wish I could have some of that. Be thoughtful about whether or not that's actually true. Me and my wife had a discussion a little while about, like, do we want a second house? And I was like, when would we, like, we love going and seeing friends over here and over there. We like traveling. We like being in different places. Is that actually, are we just doing that because our friends, a lot of our friends bought a second house out in the country? And like, why don't we just go visit them? They've got spare bedrooms. I'm perfectly happy to let them put me up. And so one is very much like, when we allow other people's preferences and what they've spent money on to drive our happiness, it's a very unhealthy thing. We need to kind of like reorient and say, we are what's important. What's going to make us happy and fulfilled and everything is what's important. Think about time. Do I actually want to be driving 2 hours to my country house every weekend? Is that actually going to make me happy? Or 4 hours back and forth? The other element of it is that there's this great paper, and it's great and it's horrible at the same time, which found that all of the neighbors of somebody who won the lottery were at significantly higher risk of bankruptcy directly after the person who won the lottery did it. And you can see what happens. There's this person, it's a random windfall, right? Like there's no amazing, like they didn't earn it. They're same neighborhood, same type of people. And all of a sudden they got a lot of money and they start spending it. They have a nicer car and other people feel like they have to keep up and they overextend themselves and they end up in a much worse position. So I think one element that at least helps me is to know that like luck is a really big component of where somebody is at any given point in time. The things that like they have, you might have stuff that they're very jealous of too. Like we don't necessarily go around saying like, man, you got 3 kids. You were so lucky. I wish I could have 3 kids. Like there are things that everybody is comparing themselves to each other and looking for ways that, again, like they think somebody else has it better off and the other person's doing the exact same thing back at you. So I think there's a lot of like reorienting yourself around what are the things that I have that really make me happy? What should I actually be doing that's going to make me happy? Don't let your spending be driven by other people's advertising.
Yeah, that's great. And so one of the, when I think about what I'm exposed to as an advisor, I get to see all different types of families and financial situations. And this goes back to the old adage, don't, judge a book by its cover. And what I would say is that you don't know what's going on financially. It could be as simple as there was an inheritance. It could be family members helping them out, or it could be that this person is way over levered and on the brink of bankruptcy trying to live a certain lifestyle. So it really doesn't make any sense to try and guess, but there's always going to be a reason behind it. And realistically, that has nothing to do with you. So focus on yourself and what you can control. All right, next example. We have clients who look at past market movements and kick themselves and say, you know what, I wish I would have put money in when the market was down, or wow, why did I put money in at the start of 2022? The writing was on the wall that the market was going to drop 20%. So, what type of behavior is this, Dan, when clients kick themselves for not making past moves?
So we generally would call it a hindsight bias, or like the other thing I've heard it called is a curse of knowledge. Once we have knowledge, we forget what it was like to not understand or to not know what was going to happen, and we're like, oh yeah, everybody knows this, and everybody should have acted like they would have known this would happen. So I think there's a couple of things here. One is that a base level thing there that's happening is the following of the market movements and sort of being engaged in that. We have diets in terms of what we eat, and we have diets in terms of what news we consume. And the first step I would say is like taking a step back and saying, what is my information diet? And is that a healthy diet for me to be consuming? Am I snacking on Doritos every 15 minutes? Or am I like eating a big nutritious meal every once in a while that has some like depth to it? So one is saying like, is the way I'm consuming news and information, is that useful to me and is it helpful to me? Another way, and this is kind of funny, this is more of a, not necessarily somebody our age, but somebody younger, is what I call the desensitization approach that I think I experienced and a lot of people who go through finance stuff experience, which is you get started and you're like, I am going to, it's like making your kid drink alcohol until they vomit. It's like, I'm going to like, you have to watch stocks every day. I want you to watch it 5 times a day. And every time you're supposed to say like, what could I have done? What's going to happen here? And real quick, after like 2 or 3 weeks, you're gonna be like, I don't know, man, stuff goes up and down. There's a lot of news in the world. I'm not sure it's a good use of my stress and my time to be doing this. Both of those want to end up in the same place with you being intentional about how am I going to consume news how am I going to consume information before I do it? And, like, what am I going to do with that information? Am I actually going to go out and change my portfolio today because of what happened last week? Can I just think about what I should do with my portfolio today without consuming news and having a little bit more of a North Star principled approach? So yeah, I think those are the 2 things that popped to my mind. What about you?
Yeah, no. So when I think about how to avoid that, I think about things like dollar cost averaging, where I'm not trying to time the market, it's time in the market. And you're never going to be able to get it right. We know that 80% of the time that pros don't even beat their index. And so for the average investor to try to be timing it, it's almost impossible. And so for us, it's focusing on the consistent contributions into an account and really riding the wave up and down and getting that average over time.
There's a similar thing here about being invested in kind of like broadly diversified funds where I like every once in a while somebody will be like, hey, do you own any Tesla? And I'm like, yeah. And they're like, do you own any Microsoft? I'm like, yeah. Like, what about Google? Like, yeah. Like is it a publicly listed stock on the US stock exchange? Well, then I own it. I'm good. Like I got a little sliver of it in somewhere. And
Yeah.
it's so nice to take the relief out of like, I don't have to pick the stocks. I don't have to pick the times. If the answer is like, if I go back, did I buy some stuff in like March 2020? Yeah, I was just dollar cost averaging. I got in at the low. I was so smart by just setting up that system and being consistent.
Yep. No, that's great. And that leads us into our next example. So in March of 2020, the world was turned upside down. Things were crazy. And within a 2-week span, we probably spoke to every one of our clients. Now, our clients wanted to know what to do. And so for us, the best course of action was taking a step back, looking at your goals, seeing how your goals have changed, and trying not to react to market movements. And I'm happy to say that we had only one client who took all their assets out of the market and exited. But so for Dan, for that client, who made that move and felt compelled to do something when the markets were going haywire, what type of behavior is that?
Yep. So generally, I'd call it some form of like panic selling. It's something that goes on where it's not just that person, right? Like they're going to be hearing is what everybody is talking about is on the news constantly. There's a relentless drumbeat of cortisol flowing into your brain, saying like, "What are you going to do about it?" And we do have a bias towards action in a lot of different settings where we would be better off sitting on our hands and doing nothing. The feeling of I am upset and I want to do something about it drives us to take actions. So there are a couple of things here. One of which is at least, and I want to actually go back, and if you like can put yourself back in March of 2020, it was scary. This wasn't some sort of like, like at some level, like Silicon Valley Bank, like had a bank run. Cool, FDIC, like we're okay. A global pandemic was genuinely a very, very scary thing, not just financially, but also for everybody's health. So it was a lot of stress to be going through.
Yeah, I think
things that,
I agree. Yeah, absolutely. It was just one point there. I think the difference with that, everybody gets concerned during market downturns about their financial health. But this is where, like you said, this was, oh my goodness, am I going to get sick? Am I going to die? Is something? You had almost a double whammy in terms of fear, which made it just that worse.
100%. Yeah. One thing that I really encourage people to do, so one of the things people are good at is like compartmentalizing things and thinking about them that way. Mental accounting is what we call it. And the people, we actually were able to look at this at Betterment clients across a lot of our retail space. And one of the things we were able to see is like people who had some sort of a safety net or emergency fund set up where they were like, I'm good for 6 months to a year worth of spending. I know I'm going to be okay because that's in some sort of like low risk cash type thing. They were less likely to freak out about the stuff that was highly exposed to the market, their retirement funds, et cetera. So one element is saying like, if you have all of your money just in one place, if it's in the market, and that's the way you think about it, it can be very scary to think about all of your money moving up and down. On the other hand, and this is something that retirees do a lot, they break their portfolios out into like, here's my next 2 years of cash, here's my 3 to 7 years of intermediate, here's my 7+ years of long-term, so that I can take more risk with the long-term stuff and feel comfortable with the short-term stuff. So one is make use of sort of like mental accounting to say like, I've got my safeness, which means I can take risks somewhere else. And that's what it's supposed to do. I'm okay doing that. The other element, oh man, there's something really interesting here. One of the tricky things is that it's not strictly like them selling that's the problem. It's that it takes a long time to get back in.
Yep, I agree. It's almost harder, in my opinion, to make that decision about when to get back in. And so that's a thing that I pose to clients when they tell me, hey, Paul, I want to get out. And I say, okay, well, let's use an example here. Say we're getting out, you bought in at 100, and then we're getting out at 80 because the market's taken a big downturn. When are you going to be comfortable getting back in? And then we think about that. And logically, are you more comfortable when it drops to 60? Or are you more comfortable when it goes back up to 100? And I try to explain that, if you think about it, when it goes back up to 100, you are basically locking in your loss. And then if you think about it, it's just buying like goods and services. You're basically saying, hey, I don't want to buy this shirt for $80. I want to wait till it goes back to 100, then I'm going to buy it. And so try to explain it that way. But yeah, I think that's the much harder. It's easier to pull yourself out of the market, but when do you get back in?
Definitely. Two things I've seen work there. One is make smaller decisions. So instead of going like, you're either all in or all out, I don't know, like take 20% out or move the allocation down a little bit to 50%. But that thing of like saying like, and I will get back in when is, again, it's future looking, it's being systematic about things. People who have that sort of approach are much better.
Yeah, and one point I wanted to add, and so we use Betterment for our RIA, and one of the pieces of technology that really came in helpful was we had a client who was going to make a change, right? They weren't going to completely get out of the market, but they wanted to shift from a stock-heavy portfolio to make it a bond-heavy portfolio. And as my client logged on to do this, they were prompted by an alert that said, hey, by the way, do you realize that making this change could have this impact from a tax perspective? And it caused them to pause and then say, wait a sec, and then pick up the phone and call me, which was awesome because we talked through it. I was able to talk them off the proverbial ledge, and then they didn't make a decision. But that was a really cool part where technology jumped in and helped us to avoid a behavior that really wasn't going to be helpful to the client in the long term. And I know as part of Dan's role, he's always trying to think how the technology can help us be better investors.
Yeah, there's nothing worse than finding out like the following April that you shouldn't have done something could have cost you a lot of money. I hate that. What month is it?
Yeah.
Oh yeah, we're coming up on that.
Whoops. Yeah. All right. So the last example we have here, at Lake Road Advisors, we work with a lot of executives who have large concentrations or large positions in their company stock. So as you climb the corporate ladder, you're going to get more of your compensation in stock, RSUs, restricted stock, stock options. And oftentimes, one of our core tenets is just diversification. So we look at the overall size of your portfolio and say, hey, this stock represents 35% of the overall net worth. This is too high. We're not comfortable. And sometimes we'll get pushback and they'll say, you know what, though, our company is poised to take off. Like, we've got some great stuff in the pipeline I can't tell you about, but I really want to hold on because I think our stock's going to skyrocket. And so for these individuals, Dan, what type of behavior is this when there may be, they don't want to diversify because they think that they have, some information, or they think that they're big believers in their company and it's going to take off?
The general term is a familiarity bias. So they are the things that you are familiar with, especially just in terms of how they make you feel comfortable or your exposure to them, right? Like, everybody knows what Coca-Cola is, yet they still advertise because if they keep saying their name, you're like, yeah, Coca-Cola. Like, I remember, I've heard a lot of it. A lot of marketing is just repetition over and over again. And it shows itself up in lots of places. Like, more about the companies that are domiciled close to you, and you're more likely to invest in them. You're going to know a lot more about your industry. And I think this is the tricky part here too. And I say this as somebody who works at a company and receives a lot of his compensation in some kind of equity option-y thing, is you want to have conviction and own that thing and say I helped generate the value of that outperformance. It's really mixed in with your pride and your feeling of success to say I contributed to that being worth more. From a very cold rational point of view, it's almost the opposite, right? I want to hedge my company's risk. It's where I get my salary from. Probably if I leave this company, I'm going to be in the same industry, and so I'm exposed to industry risk. So if anything, the cold rational part of me is I need to hedge as much of this risk as possible. I want to diversify away from it, or even this is weird, but I want to buy put options on my own company just in case something goes really bad. I've bought some insurance that's going to make me feel better at that point in time with it. So I was a good friend of mine. We were talking about they're European, and they were talking about the World Cup or something, and they're like, I want to bet on my team. You're like, well, wait, yeah, we get it. You want to support your team, that feels good. But if you bet against your team, if your team loses, you still have money. And if your team wins, you lost the money, but your team won, so you're happy. So you're kind of good either way. And that's a funny way of thinking about it, but it makes a lot more sense in terms of avoiding both having your team lose and lose your money at the same time, which is a really bad double win.
Oh, yeah, that's a very interesting way to think about it. But I did want to touch on the idea that, when we talk about all these behaviors and biases, these are examples that I've run into, and I've had my own personal situations I could talk about too. But this is by no means limited to just individual, everyday investors. This hits the professionals. And there's a good article in Fortune a couple of weeks ago about Allison Baumgates, who is a general partner at a venture capital fund. And she highlighted in her new book some of the struggles she had as a female entrepreneur, starting in the industry, and the struggles that she faced. And so what that led her to do when she was somebody who was seeding companies and investing in companies was that she allowed her own biases and her own emotionally charged kind of personal experiences to creep into some of her decision making. And she wholeheartedly admits that she invested in some female founders and ignored a lot of the warning signs that she looks for in any company. And so she made some bad decisions because she brought her own personal emotional experiences to it. And looking back said, wow, I should have done more due diligence, or I really shouldn't have waived this process just because I really felt for this person or understand what they were going through. So, long story short, this is something that everybody faces and ultimately has to consider when they're making decisions. So to wrap it all up here, we're about at a half an hour. I'm just looking, we don't have any questions outstanding. However, just wanted to recap some of the topics. And so, we talked about loss aversion and the idea of maybe setting limits or thinking about how you're going to get out of a position when you are contemplating selling. And Dan brought up a good point about considering a loss as an actual asset that you can use to offset a gain in another position. We talked about FOMO, right? And keeping up with the Joneses. It's bad, right? Focus on your own personal situation. Don't try to guess how somebody else is doing something, because it's going to be a waste of your time and it's not going to help you. Hindsight bias is another one of my favorites, right? Looking back, I should have bought that stock. I should have done this. Well, it's really, really difficult when you throw yourself into the moment to be able to see ahead. And even the pros 8 out of 10 times over the long run get it wrong. So panic selling, another really hard one. I remember, and as Dan was talking about putting yourself back in March 2020, it was a really, really scary time. And nobody knew, what was going to happen and where we were going to be. And you look back now, and not only was the market down over 30% in a month, it finished up 16% for the year. And when people ask me, never in a million years, if you told me there was going to be a global pandemic that killed 1 million people in the US, would I have wanted to buy into the stock market? And so, that's just a testament that you have no idea what's going to happen. And then I think the last point we talked about was overconfidence and perceived kind of insider knowledge. And so, and there are pressures at certain companies to hold on to your company stock and be a backer and be involved. But ultimately, the market's probably going to drive performance, and you want to be careful of that. The bias that might creep in just because you're familiar with that position or company. So, Dan, anything else to add on any of those topics?
No, I think one thing that I think is a big picture thing, though, is the purpose of being aware of these biases and everything is not to become a computer who's perfectly rational and whatever. It's like,
Right.
like part of being a fully experienced human and living a full life is like being like, yeah, this is part of it, and like I might make mistakes, and I want to, I want to avoid those mistakes in the future. But you also just want to forgive yourself and say, like, this is part of the game. Is like doing things, finding out for yourself, learning from it, and moving forward. So don't feel like it's like, like I don't go out to try and be perfectly rational and make decisions perfectly. I try and go out and like, is this something that is going to make me happier, and being very thoughtful about, like using your money to make you content rather than letting it be something that stresses you.
Great. 2 questions, Dan, just popped up. These are really good questions. So can you talk a little bit about how to evolve from having a poverty mindset into a healthy outlook on finance?
This is a huge one. I love this question. It is genuinely hard. I myself, like make more money than I thought I ever would, and I still go out sometimes. And I'm like, why are you buying a coffee? I'll make coffee at home. Why? Like at some point I was like, we should stop buying the soap that's like the gel soap because it's more expensive than the bar soap, and I should just save money. And I'm like, what? How much money am I saving here? Like 50 cents? I'm not sure. It's tough because I think one of the things it's kind of a growth mindset thing is whatever got you to here isn't necessarily the thing that will serve you moving forward. And I think for a lot of us, being scrappy, thinking about efficiency, planning well, and all of those things, I'm 42. That's at least 20 to 30 years worth of pattern building and habits that have served me very well to getting to the point where I am today. So one is saying like, you are not a fixed thing. You have time to change and evolve now. And viewing it as almost like a responsibility and a power that you have now to say like, I have enough. What am I going to do with having more than enough? There's a great book by a financial planner. I think it's called More Than Enough. I think that's actually the name of the title. That talks to like, and this isn't about being like fabulously wealthy. It's like, my parents years ago started supporting kids who needed help getting through college and set that up as kind of like a legacy scholarship thing. It's not tremendous amounts of money. I think it's like community colleges, but it really helps somebody else. The ability to shift and say, I have an endowment that it is my responsibility to use to do something with, whatever that something is, and I'm going to be thoughtful and purposeful for it. It changes that from being like, I have to have more money for having let the score go up sake, to saying like, I'm going to use the enough that I have, the more than enough that I have, to continue to push and make things better and find better ways to use that money to improve everything around me. If you got kids, supporting the PTA or supporting the local community, making sure that the playground's nice so your kids can spend time Shifting out of that poverty mindset to the enough mindset is as much about sort of letting yourself feel empowered by what you have.
Great. All right, two more quick questions. Since I'm a bookworm, what is a book that each of you would recommend for the average person seeking to know more about investing and the behavior emotions that goes with it? So I'm gonna go first, and I love Carl Richards, and I take a lot of his philosophy and thoughts when I do planning work for clients, and so I would say either The Behavior Gap is probably, he also has the one-page financial plan, but either one of those, but The Behavior Gap, if you're more concerned about making good rational decisions, it's an easy read, and I think it's very impactful.
I'm gonna break the question and give two,
Okay.
because they're different and they're good. One, if you're interested in the psychology of money, there's a book by an excellent writer named Morgan Housel called The Psychology of Money. I think it's been like #1 for quite a while now. It's a fantastic, it's like, and it's interesting. He's a great storyteller. He takes, things throughout history. It's not sort of some dry thing. So The Psychology of Money by Morgan Housel is #1. The other one that I think is really underrated and very powerful is The Millionaire Next Door, which touches on a lot of things that we went through here today about like the vast majority of millionaires in the US over the years are people who like earned salaries and like saved consistently and had enough and like had a perfectly normal retirement. And they might still be driving like a 10-year-old Subaru or something. So it was very interesting to learn about like the peer group that you might be in is not necessarily a visible peer group, but there's a lot of people out there, and how do they live their lives in a way that is fulfilling.
Great. So Dan, to wrap up here, where can people find you if they want to read more about what you're up to and some of your writings?
So I'm on Twitter a bit. I've slowed down because of my kid. It's a full-time job apparently. And I still publish things occasionally on my blog or on Betterment's blog. So just Google Dan Egan Behavioral and you will find yourself annoyed by how much stuff there is out there already.
Awesome. I want to thank you for your time today. I always enjoy chatting with you and getting your insight. And I think just the takeaway for today is we all have behavioral biases when it comes to investing. I think the best defense is just to be aware of them and to know and to think about what you can do, take a step back and realize it's just kind of part of the journey. So thank you everybody for attending today. And like I said, if you have any questions, it looks like we got through all of them, but you can reach out to us. We're happy to answer them. And hope to see you next time. I think our next webinar will be at the end of the second quarter. We'll be talking about college planning, another exciting topic. So,
can I come?
Everybody. Yeah, absolutely.
Fantastic.
All right, have a good day,
Thank you, everyone. Have a great weekend.